Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. Thank you for tuning in. Always pleased to be with you and to be joined by my co-host, Brian London in New Orleans, Louisiana. We have a new guest, Jan Nieuwenhuijs. He is a precious metals analyst with Voima Gold of Finland. He is Dutch over in the Netherlands. Welcome to the show.
Thank you for having me here, both.
Yeah, you have quite a footprint, and Brian's been following your work for a long time. The article that brought most of my attention was regarding the resurrection of a gold standard and a new monetary order. And do you believe this is an opportune time for that to happen? You mentioned before that there could be a new, like a Bretton Woods summit or a new summit of central bankers towards this. Do you want to clarify what you mean by that?
Yeah, I think that it would take a new conference, because what is happening is that this fiat money and the boundless creation of fiat money and new debt has submerged us in debt, right? So there's just a tremendous debt overhang. And the only way to get out of that is actually by inflation. And I don't think that the moment now is right to shift towards a gold standard, because we are still in plan A, and that is, keeping this system afloat. And the difficulty also is that if one country goes to a gold standard, that currency will appreciate a lot versus other currencies. So that's not good for that country. Whereas if all countries at the same time would go to a gold standard, then nobody would suffer from that appreciation. So I think, just speaking my mind here, what will happen is that they keep on printing until we get a lot of inflation. The debt will be eroded away. And what then happens is that everybody starts, there will be a lot of poverty, because the weakest in society will get hit the most by inflation. Then, of course, there will also be panic and a lot of misery by all this high inflation. And very likely we will get a new conference, and maybe we will get a new gold standard or some kind of new model that incorporates gold. But I think it's very likely that that people will see we need some discipline again in the system, because what we have tried now in the past decades is not working. It can create a lot of wealth by creating new money, but it creates a lot of inequality. It creates less productivity, because mismanagement is being rewarded by low interest rates and all sorts of things. So yeah, we're really reaching the end of this system, but it really takes the end before we can move to a new system. And I think it's likely that it will incorporate gold.
Jan, I completely agree with everything you're saying there. And what I've been saying for quite a while in Gold Newsletter is that the only thing different about this situation, throughout history, governments have always overspent, primarily through military campaigns, but also even entitlements going back to the ancient Rome and ancient civilizations. And they always got out of it by deflating the currency that those debts were denominated in, cheapening the currency. So that's always happened. It'll happen again. The difference today is that every developed economy and even developing economy is in the same boat. They've all done the same thing. They've all been racing to the bottom of the hill, just some leading and lagging and exchanging leads on the way. But they've all been deflating, or devaluing rather, their currencies through all this tremendous debt creation, etc. So they can't get ahead. They can't get a trade advantage from any other nation. And ultimately the end game of this is that the whole system, the global fiat currency system, is going to lose credibility, because they have to devalue the currency so much because the debt loads. And the other implication is that interest rates have to be near zero or really negative on a real basis going forward, everywhere, because otherwise the cost of servicing these debts would crush federal budgets.
Yeah, I agree. Yeah. They can't raise rates, and it's impossible now to get out of debt in a normal way. Usually, you get economic growth to get out of debt, or you can do austerity or increase taxes, but that's all. I don't see that happening. So I think inflation is the only way out of the enormous debt load we have.
So in timing, you're not talking about this anytime soon, but you're really just identifying, the way I see it, the process that this whole current fiat monetary regime is winding down, but it could take a decade or two, and at least in my view, going forward. Do you see it perhaps more imminent than that, or do you have any sense of timing?
It's hard. Very often when I talk about timing and I write down certain time frames, I'm wrong. So I'm sort of like, why would I? But given the current situation, the amount of money the Federal Reserve is printing, and also the social unrest now, for example, in the United States. I mean, these are direct results of monetary policy, in my mind, of inequality and of all the debris from monetary policy. So yeah, I would be surprised if it would take another 2 decades. So I would, I'm more likely to think a couple of years actually, but I don't know.
Okay,
it doesn't really matter, because for me as a gold analyst, it's more about about the outcome instead of the timing. Fortunately with gold, you don't have to time anything. You can just own it and see what happens.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hello listeners, I am Daniel Duarte and I am here with this week's CEO for our segment with the Discovery Group. As you all know, each episode we get to know more about a company within the group, our proud sponsor. Today I'm so pleased to have Claudia Tornquist with me again. She is President and CEO of Kodiak Copper, formerly known as Dunedin Ventures. The company has a portfolio of 100% owned copper porphyry projects in Canada and the US. Kodiak Copper is listed on the TSX Venture Exchange with the ticker symbol KDK. Claudia, welcome back to the show.
Hello, Daniel. Thanks for having me. It's great to be on the show.
In our last call, we went over the geophysical survey your company was performing on your project that you have in British Columbia, MPD. Why don't you bring us up to speed to what's been going on since we last talked in late April?
Yes, I'm very happy to. Quite a lot has happened. We've done a lot of work. We, on our MPD project, just as a recap, that's the copper porphyry project in southern BC, very accessible, just a couple of hours drive from Vancouver. And we made a discovery earlier this year on that project, the Gate Zone. And then as a next step in our exploration, we did a deep geophysics program. And that gave us information to more than 1,000 meters in depth. And that was the basis for us to then prioritize the next round of drill targets to follow up on our initial discovery. And we were very pleased to see with the results of this geophysics survey, a ZTEM survey, that showed us a very nice big resistivity anomaly around our discovery hole that we announced earlier in the year. That's, of course, exactly what we wanted to see. It appears we clipped a large anomaly. We only sort of intersected it right at the side. And so now with our drill targets for this drill program that's currently ongoing, we will target the center of this anomaly and drill further into it. So it's a very exciting drill program. And we started a couple of weeks ago and expect the first drill results later in August and then into September.
So What areas of the property are you prioritizing, and what are some other potential drill targets across the property?
Well, the must follow up or must drill area is obviously our gate zone discovery.
Yes.
And that's the first target where we are currently drilling as we speak, and testing this large anomaly further with some step out holes from the original discovery hole. And we then have a very similar anomaly at the Dillard zone of the project. That's 2 or 3 kilometers away, where very similar to the gate zone, we have shallow historic drilling and then a nice anomaly further at depth, which we will test as well in this drill program. And then we also have a small amount of work planned, and that's also prioritized based on our geophysics results, where we will do some more work on a gold zone in the east of our property, where in the 90s, some sampling and trenching found some really good gold results, and we will now follow up with more sampling in that area and follow up on this gold target.
Right, so enough on your plate for the following months.
That's for sure. We have a very busy summer, and it's a very exciting time, of course. And I think we have a very good shot at generating some good and interesting results for our shareholders there.
Perfect. Another highlight from your last announcement is that you expanded the size of the MPD property to 97.3 square kilometers. What is that decision based on?
That's really in the east of our property, where we added some more prospective ground around these gold zones that I mentioned previously. And it's just a testament in our confidence into the property. There was some ground available. It's mostly staked around the project, but that was available, and we jumped on that and expanded the project.
I see. So what can you tell us about the broader market of copper prices? I have read news articles that say copper prices have been surging lately. What is driving that demand for copper?
Well, it's certainly a very different market since we last spoke in April, when copper prices were not even $2.40, and now they're over $2.90. And gold prices were $1,700. Now we're looking at over $1,900. So very strong commodity prices, and in copper in particular, very much driven by the restart of the economy, particularly in China, and all the infrastructure investments that come out of the big $1 trillion stimulus programs that we see around the world. And much of those stimulus dollars haven't been spent yet, or will be spent only in the future. So I still see a lot of upside for copper in particular on the back of this economic recovery and the many stimulus programs that we see around the world.
Well, Claudia, we are going through momentous times, to say the least, and we will keep a close eye on Kodiak Copper. Thank you again for your time today and updating us on your company's opportunities.
Thank you, Daniel.
And you mentioned in one of your recent articles that European central bankers have been preparing for a gold standard since the 1970s. In what ways have they been doing that, aside from just acquiring it?
Well, the thing is that they haven't acquired anything since the 1970s. So what happened in the 1960s, we were on Bretton Woods. I think most you two and most listeners will know that system. And the world reserve currency was the dollar, and the dollar was backed by gold. And in the 1960s, there were too many dollars, and people started doubting about the parity of the dollar versus gold. So the London Gold Pool was launched to defend the gold price in the free market, and it took about 7 or 8 years, and then the London Gold Pool broke down. And long story short, of course, the Bretton Woods ended. Nixon closed the gold window, and the Europeans were not really amused by that, and other surplus countries like Japan neither. And what happened in Europe was a sense of, well, actually Nixon said it when he closed the gold window. He said temporarily. And in Europe, there was a sense. I just read a few chapters of a book here I have from a former BIS president. He was a Dutchman as well, Jelle Zijlstra. So I got a few more insights. But what they thought was a lot of central bankers, and especially in Europe, that we will need to get back to fixed parities. Also because now we have floating exchange rates all across the world. But before 1971, all through history, exchange rates were fixed because there was also always some metallic standard. And it really enhances and facilitates trade. So they started to think about how to get back to fixed exchange rates and in what kind of system. And there were a lot of conferences at the time and new agreements and things. And one of the things that Europe did was they united. And they formed the EEG, European Economic Committee. No, it's 𝗂𝗍𝗄 then. And what they did, let's say starting in the 70s, is fix their exchange rates within Europe, because most of the trade they did within Europe was, or they traded with each other, so had fixed exchange rates within Europe. But there was also this thought about, well, what about the world monetary system? I mean, you know, they knew they couldn't go on with the dollar standard indefinitely. First of all, because it was an unfair system, and it still is. You know, the dollar has an exorbitant privilege, and also because it gives the U.S. just too much power. You know, it's not. You know, they were trying to counter the dollar hegemony. So I don't know everything, of course. I only have a few breadcrumbs. By the way, it's maybe nice at this point to mention that. About 2 months ago, I asked one of a very high-ranking ex-central banker in Europe. So he worked at a European central bank, very high. And I asked him because I found a lot of stuff for my article, and I asked him, "Well, did you know about this gold policy of this and this central bank, or the central bank you worked at?" And he said, "Yeah, I knew about it, but I can't talk about it because it's confidential." So the thing is that we have a lot of central bankers and ex-central bankers that I know of in Europe that talk about everything except gold, right? So we have a lot of, this requires a lot of analysis, because we only have a few pieces of evidence here and there from history that we have to, you know, connect the dots and build an analysis on. But let's go back to the 70s. What happened in 1978 is that Europe created a European monetary system. And it was basically a mini Bretton Woods with a currency called the ECU. And the ECU was partly backed by gold. So here you can see already they wanted to integrate gold into the system. They wanted to keep it into the system. Now, the EMS system lasted until 1998, and then the Euro system was introduced. But what I found was that in the 90s, in the early 90s, a lot of European central banks started selling gold. Belgium, the Netherlands, Switzerland. Switzerland is not part of the Eurozone, but a lot of European central banks started selling gold. And in 2011, the Minister of Finance of the Netherlands was asked in Parliament here in the Netherlands, why did the Netherlands sell so much gold? And his answer was, we sold it to other important gold holding nations to equalize reserves internationally. So there was and I have another central banker saying sort of similar things. So there was some kind of sentiment or idea in Europe to spread official gold reserves across the globe and to make it, you know, proportionally equal. Of course, like I just talked about with the gold standard, if you go to a gold standard, you have to do it all at the same time. And it would be also good, or would also be a requirement, that all countries that participate have relatively the same amount of gold. Right? If you start a poker game but only one player has all the chips, that's not a fair game. So I find this very, very interesting, you know, that European central banks, they wanted to They had this countering of dollar dominance in mind. They set up the euro to compete with the dollar, to break its dominance. They wanted back to fixed parities. They started equalizing gold reserves internationally. And what happened after 2008 is that they went the extra mile. What did they do? They started upgrading their gold. So from a lot of countries like France, Germany, Sweden, we know they have upgraded their gold to current wholesale industry standards. So of course, if you go to a gold standard, the new gold standard, you need liquid gold, right? You can't show up with very old bars that can't be accepted and things. So we know of the upgrading of gold. A lot of countries started repatriating gold. Germany, the Netherlands, Austria. Then we have some quite bold statements by European central banks, like my own central bank, the Dutch central bank, about gold being the perfect piggy bank, and it always retains its value. And if the system collapses, the gold can be used to rebuild a new system. And the German central bank calls it the bedrock for stability of the international monetary system. All these statements, I mean, I know of Brian, he works in the gold industry very long. This was unheard of 10 years ago, right? So we see all, if you piece together all these developments, I think in any case, Europe, but we could talk about Russia and China and other countries too, but Europe is slowly moving towards gold. They know, and I mean, it makes sense, right? I mean, you can see it happening. This money printing and interest rates, negative interest rates, it's going nowhere. So I think it makes a lot of sense that we're slowly getting back to gold. I can't remember what the question was, but I hope it is an answer.
I've got a question for you. And it seems, Jan, that you're developing a thesis there that nobody else has. So you're blazing new territory there. But you also blaze new territory in your analysis of Chinese gold flows. In particular, I found I really enjoyed an article you pointed out to me on Twitter not long ago about the ebbs and flows of gold from east to west as the price rises. Basically, Western investors, Western demand follows the price higher, whereas Asian demand, they're more bargain hunters. They support the price in downturns. And that's something, I've seen over decades. But I also found it interesting. You were quoting Timothy Green extensively in that report. And, I know you're one of the best gold researchers out there today, if you even know who Timothy Green is. He used to write for Gold Newsletter back in the 70s and 80s, so I was very familiar with his work. But the thesis there is that when the price falls, they buy. But when the price rises, as it is now, then Asian investors tend to dishoard. They tend to sell into the market because they're basically playing the market with gold as savings. Do you think that trend may change today, given what's happened in China, where China has encouraged gold ownership, where Chinese gold reserves have been built up as part of some greater plan, we theorize, and possibly that China is viewing gold in its citizens' hands, seen as no private property anyway, technically, that it views gold in its citizens' hands as de facto national gold reserves, given capital controls and everything else. Is it possible for this Chinese gold hoarding while the price was low to reverse if we do have the significant run up in gold prices that really we're seeing right now?
Yeah, and I think we're already seeing the dishoarding from China. If you look if you look at the last 2 months, China has been a net exporter. There was a really interesting analysis, this whole West-East ebb and flood of gold, as I called it. I'm quoting Timothy Green here, that taught me so much. I mean, his books, if you read books, you learn more about gold than reading a lot of other books. But I was also thinking, so the trend was clear in the past, but will it hold? I mean, Also because it's a bit cultural, and maybe in the East they're getting a bit more of a Western mindset towards gold, and more. It's a speculative thing, and safe haven if you need it, but if you don't need it, sell it. But no, I see the trend is still there. China has been a net exporter for the last 2 months. And the thing is that I think the Chinese government wanted that they didn't sell, because, as you know, exports are forbidden from the domestic market, the Chinese domestic market. You have free trade zones where you can import and export freely, but in the domestic market, previously it was forbidden to export gold. But what happened when the gold price went up, the selling pressure in China also increased. So what we saw was that on the SGE, the Shanghai Gold Exchange, gold was traded because of the selling pressure, was trading at a discount to London. So it became very strange for the People's Bank of China, who was sort of like the manager of the Chinese gold market, sets the rules. This discount became very uncomfortable, and they decided to open the gates, actually. And now there is gold coming out of China. And so they are dishoarding. According, I have to say that I'm in the industry of writing articles. So what I always do is I focus on one topic, and then I do a lot of reading and writing, and I publish it. This specific topic, I haven't saw all the numbers of like Dubai, India, important countries. I'm not tracking all the data every month, but I know that China is dishoarding, and other countries, like in India, you see demand also very low. I think I saw also dishoarding from Dubai back to Switzerland again on this rising price. This is what we have been seeing for at least 80 years, that if the price is going up, you see, the gold moving from east to west, and when the price is going down, you see it moving from west to east, and the east providing a floor under the gold price. So I think,
and they are providing a bit of a dampener on the upswing as well. So they really moderate the swings, the broad swings in the gold market, I guess.
Well, in terms of dampening the upswings as well, they're selling into, if they wouldn't sell, the gold price would rise higher, right? So
right.
Is
right.
that true?
Yeah, that's what I'm saying.
Oh, right.
So yeah, so they're mitigating or moderating the rise on the upside. So
yeah, and for them,
whatever the trend is, I guess.
Maybe nice for the listeners is that we have so financialized in the West that a lot of people, like my mother, for example, if I talk to gold, I mean, she's 70, by the way, she should know, but if I talk about gold to my friends, they have no idea. I mean, I've been talking their heads off for 10 years, and they're still really gold. I don't know, so it's but in the East, where things developed in a different pace, etc., gold is still very. It's like a banking account for them, right? So they have a much longer term view with regard to gold. So if they see it going up in price, they think, well, I'm having this gold. This is my family wealth. It's going up in price now. I can sell a little bit. It's because of the long-term view in the East that they sell a little bit when the price goes up, and when it comes down, they think, hey, we see, buy low.
Yeah, using it as a currency as much as anything, switching from one currency to another.
Yeah. Store of value.
Okay.
Right.
Okay, thank you very much.
Jan, great to have you on the podcast. As you know, I'm a big fan of your work, so please keep it up.
Thank you very much, Brian.